Today, our mission is to completely unpack a foundational piece of curriculum. It's reading Module 2 from the Quantitative Methods series.
Titled Time Value of Money in Finance.
Right. We're going to explore the absolute bedrock of all asset valuation because the core truth we're dealing with today is a concept that, well, it sounds simple on the surface, but it has profound implications.
Money today is worth more than money tomorrow.
Exactly. And quantifying that exact difference, measuring the precise mathematical gap between today's dollar and tomorrow's dollar, that is what makes the entire machinery of modern finance work.
Okay, let's unpack this. Because I know that when you open a quantitative methods textbook and you are suddenly hit with a wall of summation symbols, complex algebraic formulas.
A sea of Greek letters.
Right, a sea of Greek letters. It can feel incredibly intimidating. It feels like you need a PhD in mathematics just to figure out what a basic bond is worth.
It really does.
But we are going to remove that intimidation factor completely. We're taking a comprehensive, step-by-step journey through this material today, and we're going to translate all of that dense math into intuitive visual concepts for you.
We have a clear roadmap for you today, resting on 4 major pillars.
First, we're going to look at valuing fixed income instruments.
Second, we'll transition into valuing equity instruments.
Third, we're going to reverse engineer the market by calculating implied returns and growth.
And finally, fourth, we'll uncover the governing law of it all, which is the principle of cash flow additivity and no arbitrage.
The progression of that roadmap is very intentional, by the way.
Oh, absolutely. We start with the guaranteed contractual world of fixed income to build our mathematical foundation. It's just so much easier to grasp these concepts when the cash flows are legally promised to you.
Right.
Then we take those established tools and apply them to the uncertain, theoretically infinite world of equities.
And once we've built the models from the ground up, we basically flip the script to show how observing market prices allows us to extract hidden expectations.
Exactly. Finally, we show how these formulas aren't just academic exercises. They literally hold the entire global financial system in a state of mathematical equilibrium. If you understand these 4 pillars, you understand how the global market prices both risk and time.
So let's jump right into pillar 1, which is fixed income instruments and the time value of money.
Let's do it.
To set the stage, when we talk about a fixed income instrument, which is usually a bond or a corporate loan,
Right.
what are we actually looking at?
At its core, it's essentially a contract. An issuer, like a government or a corporation, borrows money from an investor today in exchange for a rock-solid, legally binding promise of future repayment.
And in this context, the terminology is incredibly important for the exam. When we talk about the discount rate in fixed income, we're usually referring to the market interest rate.
Yes. And when we talk about the overall annualized rate of return, an investor earns if they buy that bond today and hold it all the way to the very end of its life.
You call that the yield to maturity.
Or YTM. The fixed income universe generally operates on 3 main cash flow patterns. Understanding the distinct mechanics of each one is crucial for anyone studying quantitative finance.
So let's look at pattern number 1, the discount instrument, which is often called a zero coupon bond.
This is fixed income in its absolute purest, most distilled form.
But how do we actually visualize the timeline of a zero coupon bond?
Picture a completely empty timeline. The mechanics here are as straightforward as finance gets. The investor parts with their money today. They pay an initial price. That's your present value, or PV, sitting at year 0 on your timeline.
Year 0. Okay.
Then they simply wait. They receive absolutely no periodic interest payments along the way. The timeline is completely blank until you reach the very end of the contract at maturity.
And at that exact moment,
they receive a single lump sum principal cash flow, that is your future value, or FV. The entire return on their investment is derived solely from the difference between the discounted price they paid up front and the full face value they receive at the end.
So if I'm looking at a 20-year bond from the Republic of India, as outlined in the source material, and they promise to hand me exactly 100 Indian rupees at the end of 2 decades,
right?
How do I actually figure out the haircut I need to take on that price today? Because obviously I'm not going to hand them 100 rupees today just to get 100 rupees back in 20 years.
The market dictates the haircut through the discount rate. Let's walk through the conceptual mechanics of the formula. The present value is equal to the future value divided by a discounting factor.
Which is?
That discounting factor is simply 1 plus the market interest rate raised to the power of how many years you have to wait. So if the current market discount rate, the yield to maturity, is 6.70%, You take your rate of 0.067, add 1 to get 1.067.
And because you're waiting 20 years, you have to penalize that future money 20 separate times.
Exactly. So you raise 1.067 to the 20th power.
Let me visualize that. It's like dragging that 100 rupee payout backward across a timeline, and every time it crosses a year marker, it shrinks by 6.7%.
That's it.
So by the time I drag it all the way back across 20 individual years to today, that compounding effect has shrunk it massively.
That is the perfect way to visualize it. When you raise 1.067 to the 20th power, you get a compounding factor of roughly 3.659.
Okay.
Finally, you divide your future value of 100 by that 3.659 factor, and you arrive at a present value of exactly 27.33 Indian rupees.
So I hand over 27.33 rupees today, put the bond certificate in a drawer, wait 2 entire decades, and they hand me 100 rupees.
That is the essence of a pure discount bond.
But the market isn't a vacuum. Things change over 20 years. What happens to the price of that bond on my screen as time actually passes, or if the central bank suddenly decides to change interest rates?
That dual nature of price changes is where the complexity lies, and it is a vital concept for you to grasp for any quantitative exam. A bond's price is constantly being pushed and pulled by two distinct forces.
Time and rates.
Right. First, let's look at the passage of time. Let's assume the global macroeconomy freezes and interest rates stay perfectly flat at 6.70% for years. As time passes, your bond becomes more valuable simply because you're getting closer to payday.
Because I don't have to drag the money back as far on the timeline anymore.
Precisely. If you hold that India bond for 3 years, you now only have 17 years left to wait. If you run the exact same mental exercise dragging the 100 rupees back 17 years instead of 20, the discounting factor is smaller.
So the math changes.
Mathematically, your present value rises from 27.33 up to 33.21 rupees. This natural, predictable upward pull toward the face value as time evaporates is called accretion. The bond's price naturally accretes toward par.
But the second force is the interest rate environment, which we know never stays frozen. Let's say literally the day after I buy this bond for 27.33, inflation spikes, and the market interest rate suddenly jumps up to 7.78%.
Okay.
My timeline hasn't changed. I still have 20 years to wait. But the penalty for waiting just got much harsher.
In that scenario, the price of your bond immediately drops. The market is now demanding a 7.70% return for tying up capital for 20 years. Because new bonds being issued today are offering that higher 7.70% yield, your older bond, which is locked into the mathematics of a 6.70% yield, is suddenly much less attractive.
It's inferior.
Right. To convince a new buyer to take your inferior bond off your hands, you have to offer it to them at a steeper discount. If we drag that 100 rupees back 20 years using a 7.70% penalty, the present value plummets to 22.68 rupees.
It's a brutal seesaw effect. Rates go up, prices go down. It's the fundamental law of fixed income gravity.
It really is.
Now, staying with discount bonds, we have to talk about one of the most mind-bending examples provided in the source material, the negative yield phenomena.
Yeah, yes.
We're looking at a German 10-year government bond that was issued back in 2016. At issuance, this bond had a yield to maturity of negative 0.05%.
Which is wild to think about.
To put that in pure, undeniable cash terms, investors were paying a present value of 100.50 euros today in order to receive only 100 euros a full decade later. I have to ask, why on earth would someone willingly enter into a legally binding contract to lose money?
It's a great question.
It completely breaks the intuitive rule we established at the beginning that money today is worth more than money tomorrow.
It feels like a paradox, absolutely. And it highlights why quantitative models must always be viewed through the lens of macroeconomic reality. In a normal, healthy economic environment, you demand compensation for parting with your liquidity. You demand a return on your capital. But the European economic landscape in 2016 was far from normal.
They were dealing with profound economic stagnation.
Exactly. You need a flawless safe harbor.
Right.
The German government effectively told the global market, we have the strongest balance sheet in Europe. We will guarantee your billions are safe for 10 years. But because safety is in such high demand right now, we are going to charge you a tiny annualized storage fee of 0.05% for the privilege.
That is fascinating. So the mathematical formula didn't break down at all.
Not at all.
The math dutifully processed the inputs it was given. It just reflected a bizarre reality where the risk-free rate dropped below zero because safety became a scarce commodity.
The math simply reflects the market's collective behavior. When panic or regulatory requirements drive massive demand for a safe asset, the price is bid up so high in this case to 100.50 euros that the resulting yield mathematically must turn negative to reconcile with the 100 euro payout.
All right, let's transition to pattern 2, periodic interest or coupon bonds.
Let's do it.
The zero coupon bond is a great conceptual starting point. But most investors don't want to wait 10 or 20 years to see a single drop of cash flow. They want income along the way. How does the math change when the bond actually pays out periodic interest?
A coupon bond is simply a series of smaller individual discount calculations stacked on top of each other. Instead of staring at an empty timeline with just one payment at the end, your timeline is now populated with milestones.
Okay.
You receive periodic interest payments, the coupons at regular intervals, plus the final principal at maturity. The fundamental logic doesn't change. The formula just expands.
So it's the sum of the parts.
Yes. The present value of a coupon bond is equal to the sum of the present values of every single individual coupon payment, calculated separately, plus the present value of the final principal repayment.
Let's ground this with the Greek government bond example from the text. We're looking at a 7-year bond with a 2.00% annual coupon. The future value, or par value, is 100 euros.
So my timeline now has a 2 euro payment sitting at year 1, another 2 euro payment at year 2, all the way up to year 7, where I get my final 2 euro coupon plus my 100 euro principal back. How do I turn that entire string of payments into a single price today?
You apply the exact same dragging visualization you used for the zero coupon bond, but you do it 7 different times.
7 times.
You take year 1's 2 euro coupon and drag it back 1 year, discounting it by the market rate. Then you take year 2's 2 euro coupon and drag it back 2 years, discounting it more heavily. You repeat this laborious process all the way to year 7.
And at year 7.
For that final milestone, you take the massive 1 or 2 euro cash flow that is the final coupon combined with the principal and drag it all the way back across 7 years. Once you have calculated the present value of all 7 individual milestones, you simply sum them together. That total aggregate number is the fair market price of the bond today. And there's a crucial exam takeaway here for anyone listening who might be dreading doing 7 separate present value calculations on a calculator. There's a specific scenario, a mathematical shortcut, where you don't even need to do all that heavy lifting.
Yes, there is.
If the market discount rate, the yield to maturity, happens to be exactly equal to the coupon rate written on the bond, what happens to the price?
The bond will always mathematically price exactly at par, which is 100. If that Greek bond pays a 2.00% annual coupon and the broader market environment demands exactly a 2.00% return for that level of risk, the present value of all those discounted cash flows will perfectly sum up to the 100 euro face value.
It's perfect equilibrium.
It represents a state of perfect equilibrium between what the bond offers and what the market demands.
So if I see a bond with a 5% coupon, and the problem tells me the yield to maturity is 5%, I don't even need to touch my calculator. The price is 100.
Correct. And understanding that anchor point makes it much easier to intuitively grasp price movements. If the market rate rises above the 2% coupon to, say, 3%, the bond is now offering substandard interest.
So the price falls.
Right. Therefore, its price must fall below 100, trading at a discount, to compensate the new buyer. Conversely, if the market rate falls below the 2% coupon to 1%, the bond is suddenly highly lucrative, so its price will rise above 100, trading at a premium. The par value is the fulcrum of the seesaw.
We've talked about getting a single lump sum, and we've talked about getting annual coupons with a lump sum at the end. But let's move to pattern 3, level payments.
This is a big one.
For most people listening, their biggest personal exposure to fixed income doesn't look like either of those first 2 patterns. It looks like their mortgage or their car loan. How does the math handle a situation where you are paying both interest and principal at the exact same time in equal installments?
The mechanics of a fully amortizing loan are unique and highly structured. Unlike a standard coupon bond, where the principal sits untouched until maturity, an amortizing loan aggressively attacks the principal balance over the life of the loan.
Every single month.
Every single uniform payment you make is split into 2 buckets. One bucket covers the interest owed on the outstanding balance for that specific period. The second bucket goes directly toward reducing the principal.
And as the principal shrinks.
Because the principal shrinks slightly with every payment, the interest burden shrinks the next month, allowing more of the payment to attack the principal. By the very last payment of the schedule, the principal is completely extinguished or amortized down to 0.
Let's break down the 30-year fixed-rate mortgage example provided in the text. This is where candidates constantly trip up on exams. The scenario is you're buying a property for $1 million. You're financing 80% of it, so your starting loan amount, your present value sitting at year zero is $800,000.
Oh.
It's a 30-year fixed-rate mortgage with an annual interest rate of 5.25%. We need to calculate the exact level monthly payment. Where is the quantitative friction here? Why do people get this wrong?
The fatal trap candidates fall into is a mismatch of frequencies. They see an annual rate of 5.25% and a 30-year horizon, and they immediately plug those numbers into the annuity formula.
Right.
But the formula will break if your inputs don't match the actual payment frequency. If you are making payments every single month, the mathematical engine must be calibrated to monthly intervals. You cannot feed it annual data.
Okay, so before I even look at the formula, I need to translate the terms of the loan into monthly language. Step one, I need a monthly interest rate. I take the annual rate of 5.25% and divide it by 12 months. That gives me a monthly rate of 0.4375% or 0.004375 in strict decimal form.
And step two is translating the time horizon. A 30-year mortgage multiplied by 12 months per year equals 360 total payment periods. Your time variable, T, is 360, not 30.
Now we can approach the annuity present value formula. We know the present value is $800,000, but we need to solve for the recurring payment, which is often denoted as A for annuity payment.
Right.
When you rearrange the standard formula to solve for A, it looks quite daunting.
Yeah.
You take the present value and you multiply it by a large fraction. The monthly rate A divided by the quantity of 1 minus, open parenthesis, 1 plus R, close parenthesis, raised to the negative T power.
It is a heavy equation, but it is just executing the logic we discussed. It's calculating exactly how much cash needs to be extracted every month to perfectly cover the interest and whittle the $800,000 down to zero by month 360.
So let's look at it.
If we carefully plug in our calibrated numbers, PV is 800,000. Our rate R is 0.004375. Our periods T is 360. We calculate the denominator factor first. 1 plus 0.004375 is 1.004375.
Then raise it.
We raise that to the negative 360th power, which calculates the profound discounting effect over 3 decades. We subtract that tiny resulting decimal from 1. We then divide our monthly rate, 0.004375, by that denominator result. Finally, we multiply that entire resulting factor by the 800,000 principal.
When you meticulously crunch all of those numbers, the chaos of the formula collapses into a perfectly clean, level monthly payment of $4,417.63. Every single month for 30 years, you write a check for exactly $4,417.63.
And while the cash flow itself remains a constant level annuity from the borrower's perspective, the internal mechanics of that payment shift dramatically over time.
How so?
In month 1, almost all of that $4,417 goes toward paying the hefty interest on the full $800,000 balance. Barely a sliver touches the principal. But by month 359, the principal balance is tiny, the interest owed is negligible, and almost the entire payment goes toward final principal reduction. The math perfectly orchestrates that internal sliding scale while keeping your monthly cash outflow perfectly flat.
And that comprehensive breakdown wraps up the core of fixed income time value of money. Whether you're dealing with a single massive discount payment 2 decades from now, a predictable series of annual coupons, or a perfectly level amortizing monthly mortgage payment, the unifying principle remains absolute.
It does.
Every future dollar is dragged backward across a timeline and penalized based on how long you have to wait and what rate of return the market currently demands.
Beautifully summarized.
Which brings us seamlessly to Section 2, equity instruments and the time value of money. We are shifting gears entirely here. We're leaving the safe, guaranteed, legally binding contractual world of bonds and stepping into the indefinite, discretionary, highly volatile world of common stocks.
It's a very different environment.
With a bond, the quantitative process feels secure. You know exactly when it matures, and you know exactly what they legally promise to pay you. But how in the world do you mathematically value a share of common stock? It never formally matures. It has no end date. And worse, the company's board of directors is under zero legal obligation to ever pay you a single dime in dividends.
It requires a profound shift in analytical perspective. To value an equity instrument, we do not abandon the time value of money. The law of gravity still applies.
Okay.
But instead of discounting contractual guarantees, we must apply the formulas to expected, highly uncertain future cash flows, which for an equity investor ultimately manifests as dividends. The fundamental challenge here is time. Because a corporation is legally structured as a going concern, meaning it theoretically lives forever, we're faced with the daunting task of discounting an infinite series of expected dividends stretching out until the end of time.
The word infinite usually makes math incredibly difficult.
Yes.
Let's start with the most basic approach to this. Model 1. Constant dividends, which is formerly known as the perpetuity. This is the absolute simplest equity model. It assumes a company pays the exact same dividend amount year in and year out, forever.
Right. Now, realistically, common stocks rarely do this, but preferred stock often behaves exactly like a perpetuity.
But wait, if the formula requires me to drag cash flows back from the future, how do I actually do the math? I can't calculate an infinite number of years on my calculator. I'd be pushing buttons forever.
That is where the beauty of mathematical limits comes into play. Summing an infinite series of cash flows sounds impossible, but because the dividend amount never changes, and we assume the required discount rate never changes, the math naturally converges.
How does it converge?
Think about dragging a cash flow back from year 1000. By the time you shrink that dividend by the discount rate 1,000 times over, its present value today is essentially zero. It vanishes into microscopic dust.
Ah, I see.
Because the distant future cash flows become mathematically negligible, the infinite series collapses into a beautifully simple, elegant algebraic equation. The present value of a perpetuity is simply the constant dividend amount divided by the required rate of return. Present value equals D divided by R.
Let's apply that to the example provided. Shipline PLC. Let's say Shipline issues preferred stock that pays a steady, unyielding dividend of 1.50 BOSIC, Great British pounds per year, forever. Investors surveying the market assess Shipline's business model and decide they require a 15% annualized return to justify taking on the risk of holding this stock. What is the mathematically fair price for this stock today?
It's a one-step calculation. You take the constant 1.50 of GBP dividend and you divide it by the 0.15 required return in decimal form. The math unequivocally states that the stock price should be exactly 10.00 GBP.
Just 10 pounds.
Yes. If you pay exactly 10 GBP today and you collect 1.50 BOS every single year until the end of time, your yield on that initial investment is exactly your 15% required return. The pricing is perfectly aligned with the risk expectation. It's incredibly clean. But let's be real, very few successful companies stay exactly the same size forever. Healthy companies retain earnings, they reinvest in their business, their profits grow, and consequently, their dividends grow over time.
Exactly.
That reality brings us to Model 2. Constant dividend growth, which is most famously known across the financial industry as the Gordon growth model.
Realistically, any robust equity valuation needs to account for that compounded growth. If we assume a company's dividends will grow at a constant steady rate, which we denote as G forever, the simple perpetuity formula adjusts slightly to accommodate that expanding cash flow, but it remains remarkably elegant.
So what's the formula?
The present value today equals the next expected dividend, that is the dividend expected at time t plus 1 divided by the required return R minus the growth rate G. Here's where it gets really interesting, because the math starts to impose rules on reality. Let's look closely at the denominator of that Gordon growth equation, the required return R minus the growth rate G. For this formula to function mathematically, there is an absolute ironclad rule. The required return R must be strictly greater than the perpetual growth rate G.
It has to be.
If you're an optimistic analyst and you determine you need a 10% return, but you project the company is going to grow its dividend by 12% every year forever, what happens to the valuation?
The mathematical model literally breaks down, and it does so to prevent an absurdity. If your growth rate G is larger than your required return R, your denominator becomes a negative number.
Which means a negative price.
Right. That would imply the stock has a negative price, meaning the seller would have to pay you to take this incredibly fast-growing, hyper-profitable company off their hands, which is obviously impossible. Alternatively, if R exactly equals G, your denominator becomes 0. Dividing by 0 means the present value of the stock mathematically shoots to infinity.
Why does that happen conceptually? Why does the math forbid a company from growing at 12% forever if the discount rate is only 10%?
Think about the mechanics of the timeline we established earlier. Every year, the dividend gets 12% larger, but you are only shrinking it by 10% when you drag it back to the present. Because the growth outpaces the discount penalty, the present value of each future dividend actually gets larger the further out in time you go, rather than shrinking into dust.
This is just compounding infinitely upwards.
You're summing an infinite series of ever-expanding numbers, which naturally leads to an infinite nonsensical valuation. Therefore, the Gordon growth model imposes a profound macroeconomic truth. No single company can grow faster than the overall global economy forever. If it did, that one company would eventually consume the entire GDP of the planet.
That makes perfect sense.
Eventually, the law of large numbers dictates that a company's growth must slow down to a sustainable, mature rate that is lower than the market's baseline required return.
Which perfectly naturally transitions us into Model 3. Changing dividend growth, often called the two-stage dividend discount model.
This is a practical one.
This is exactly how professional equity analysts handle startups, tech companies, or aggressive growth stocks that are expanding incredibly fast right now, but will inevitably mature, saturate their market, and slow down later. We know we can't use the simple Gordon growth model on a company growing at 30% today because that violates "there must be greater than G" rule we just discussed. So how do we build a model that handles reality?
We solve the problem by breaking the company's infinite timeline into two distinct, manageable stages. The first stage is the high growth phase. This phase lasts for a specific, finite number of years where we allow the company to grow at an aggressive rate.
Damn, because it's finite.
Because it's a finite period, we can manually calculate and discount each dividend individually without the math breaking down. The second stage is the mature phase. At a specific point in the future, we assume the high growth ends, the company matures, and it settles into a lower, constant, perpetual growth rate that satisfies our greater than G rule. We then value that entire infinite second stage as a single lump sum.
Let's visualize this by upgrading Shipline PLC's business model. Assume Shipline's current dividend, the one they just paid today, is 1.50 GBP. They just announced a massive new logistics contract. For the next 3 years, they're going to experience a high growth rate of 6%.
Okay, that's stage one.
But after year 3, the contract normalizes, they hit maturity, and their dividend growth drops to a perpetual conservative 2%. The investors, viewing the overall risk profile, still require a 15% return to hold the stock. This sounds incredibly complex. How on earth do we put a price on this today?
Meticulously, step by step. Imagine drawing the timeline on a whiteboard. Step 1 is calculating the present value of the specific dividends received during the high growth phase, that is just years 1, 2, and 3. We have to manually grow the current 1.50 dividend by 6% each year to find out the actual cash the investor will receive.
Right.
Let's find the year 1 dividend. We take the 1.50 base and multiply it by 1.06. That gives us an expected year 1 dividend of 1.59 GBP. We drag that 1.59 back 1 year on the timeline, discounting it by our 15% required return. So 1.59 divided by 1.15 gives us a present value of 1.383 GBP.
That's year 1.
Now the year 2 dividend, we take year 1's 1.59 and grow it by another 6%. 1.59 times 1.06 equals 1.675 GBP. We drag that back 2 years across the timeline.
Right.
1.685 divided by 1.15 squared gives us a present value of 1.2786 GBP. We drag that back 3 full years. 1.786 divided by 1.15 cubed gives us a present value of 1.175 GBP.
So we sum those.
If we sum those 3 discounted milestones together, 1.383 plus 1.274 plus 1.175, we determine that the present value of the first 3 years of high growth cash flows is exactly 3.832 GBP.
Okay, I have the first 3 years locked down, but the company doesn't just spontaneously vanish after year 3.
Yeah.
He keeps operating forever. We have to value the rest of eternity.
That brings us to step 2, valuing the infinite mature phase. We need to find what is called the terminal value of the stock at the end of year 3. Imagine you are standing at year 3 on your timeline. The company is now entering its stable 2% perpetual growth phase.
Because the growth is stable and lower than 15%.
We can finally deploy the Gordon growth model, but we are applying it as if we are living in year 3. To use the model, we need the next expected dividend, which is year 4. We take our actual year 3 dividend of 1.786 and grow it by the new, slower 2% rate. 1.786 times 1.02 equals an expected year 4 dividend of 1.822 GBP.
Plug it into the formula.
Now, we plug that into the Gordon formula. Terminal value at year 3 equals the year 4 dividend divided by R minus G. That is 1.822 divided by the quantity of 0.15 minus 0.02. which simplifies to 1.822 divided by 0.13. That calculation tells us the fair value of the entire remaining infinite life of the mature company as of year 3 is 14.015 GBP.
But wait, That 14.015 GBP is what the mature company will be worth 3 years from now. We aren't sitting at year 3, we're sitting here today at year 0 trying to figure out what to pay for the stock right now.
Exactly. That is the critical final maneuver. You treat that massive 14.015 GBP terminal value as if it were a giant, single lump sum, zero coupon bond payment sitting at year 3. You must drag that entire chunk of value back 3 years to today.
So divide it again.
You take 14.015 and divide it by 1.15 cubed. When you apply that steep 3-year discount penalty, the present value of the terminal phase shrinks down to 9.215 GBP.
So to get the final complete stock price today, we add the two stages together. We take the present value of the short-term high-growth dividends, which we found was 3.832 GBP, and we add the present value of the long-term mature terminal value, which is 9.215 GBP. The grand total, the mathematically justified share price today, becomes exactly 13.05 GBP.
It truly is a beautiful piece of financial architecture. You are meticulously building a timeline, placing every expected operational cash flow exactly where it belongs, forecasting the maturation of a business cycle, and pulling all of that disparate future data back to a single actionable focal point, today's price.
And that wraps up our second pillar. We've mastered the foundational models. We know how to calculate what a fixed income bond or a growing equity stock should theoretically be priced at, assuming we know the inputs. But in Section 3, decoding the market implied return and growth, we're going to completely flip the script.
Because in the real world
of professional finance, you don't usually sit around calculating the price of Apple or U.S. Treasuries from scratch. You just open your brokerage app or your Bloomberg terminal, and the price is already blinking right there at you on the screen. The price is an undeniable, observable fact.
That is because the aggregate global market has already done all the heavy lifting. Millions of investors buying and selling have already processed the math and settled on a clearing price. Our job as analysts changes here.
How so?
Instead of using assumptions to find the price, we use the known price to run the time value of money formulas in reverse. If we know the price on the screen and we know the contractual cash flows of a bond or the current dividend of a stock, we can use algebra to extract the market's hidden collective expectations about risk and growth. We are no longer solving for present value. We are solving for R, the implied return, and solving for G, the implied growth.
Let's start with implied return and fixed income. And let's go back to our bizarre German bond with negative yield to see what actually happened to the people who bought it. Remember, in 2016, institutions bought that bond at a premium price of 100.50 euros, fully expecting to hold it for 10 years and lose a tiny bit of money for safety.
Yes, the storage fee concept.
But 6 years later, the macro environment violently shifted. Rampant inflation hit the Eurozone, central banks began hiking rates, investors panicked, dumped their safe haven assets, demanded much higher yields, and the price of that exact same German bond plummeted to 95.72 euros on the open market.
Let's run the math backward to separate the original expectation from the harsh realized reality. The original investor bought at 100.50. 6 years later, their holding is only worth 95.722. We use the geometric return formula to find the actual implied return they experienced over that specific 6-year holding period.
So ending value over beginning value.
We take their ending portfolio value of 95.72, divide it by their beginning portfolio value of 100.50. We take that resulting fraction and raise it to the power of 1 over the number of years held, so 1 divided by 6. Finally, we subtract 1 to isolate the percentage rate.
When you crush that formula, the actual annualized return for those 6 years is a painful negative 0.81%. They initially modeled and expected to lose a tiny 0.05% a year as a storage fee. But because the macroeconomic tectonic plates shifted and the bond price crashed, they actually suffered a much deeper realized loss of 0.81% per year.
But the beauty of the market is that it constantly recalibrates for the next participant. Look at the new buyer who steps in at year 6. They look at the screen and see a price of 95.72. They know they only have to wait 4 more years until maturity to get the guaranteed 100 euro principal.
So a math resets for them.
If we run the forward-looking math for them, expected ending value of 100, divided by their beginning cost of 95.72, raised to the 14 power, minus 1, their implied yield to maturity for the remaining life of the bond is a positive 1.7%. The market brutally recalibrated the price to offer a mathematically sound, positive yield to the new buyer in an inflationary environment, entirely by inflicting a severe capital loss on the original buyer who locked in the wrong rate.
We see the exact same punishing dynamic with the Greek coupon bond. It was issued at a perfect par price of 100 with a 2% annual coupon. After 2 years of holding it, inflation spikes across Europe, and the secondary market price of that bond drops to 93.091.
If we calculate the actual realized return for the original Greek bond investor over those 2 years, the math is slightly more complex because we have to account for the cash they actually received. We look at the severe price drop from 100 down to 93.091, but we also add in the €2 coupon payments they collected along the way.
So it's buffered a bit.
Even with that coupon income acting as a buffer, the massive capital depreciation means their actual annualized holding period return was a painful negative 1.445%. Their 2% expected return was completely wiped out by the price collapse. But again, look at the new implied reality.
Right.
Because the bond is now trading at such a steep discount at 93.091, a new investor buying it today and collecting the remaining coupons will earn a mathematically implied yield to maturity of 3.532%. The blinking price on the screen tells you exactly what level of yield the aggregate market now demands to hold Greek debt.
Now, let's take this powerful reverse engineering concept to equities. This is where we uncover the implied return and growth embedded in stocks, and specifically, we need to talk about the PE ratio connection. The price-to-earnings ratio is unequivocally the most quoted, discussed, and analyzed statistic on global financial news networks.
Oh, without a doubt.
You hear it constantly. Stock X is trading at 20 times earnings, while Stock Y is a value at 12 times earnings. But for a quantitative candidate, it is critical to understand that the PE ratio is not just some random, arbitrary multiple pulled out of thin air. It is mathematically, fundamentally tethered to the exact time value of money formulas we just built.
What's fascinating here is how directly we can bridge the gap between abstract academic valuation models and the gritty, everyday metrics used on Wall Street. Let's take our standard Gordon growth model. Present value equals the next expected dividend divided by R minus G. We can manipulate this algebraically to reveal its true nature.
Okay, let's go.
First, let's divide both sides of the entire equation by the company's expected earnings per share. On the left side of the equal sign, we now have price divided by earnings. That is the literal definition of your forward PE ratio. On the right side of the equal sign, the numerator becomes dividend divided by earnings, all still sitting over the denominator of R minus G. Well, conceptually, what is dividend divided by earnings? If a company earns $1 and pays out 40 cents in dividends, that 40% represents their dividend payout ratio.
The percentage of core profits the company chooses to give back to shareholders rather than reinvesting.
Right. So by simply dividing by earnings, the academic formula transforms into a practical tool. Forward PE ratio mathematically equals the dividend payout ratio divided by the quantity of R minus G.
That is a massive light bulb moment for anyone studying this. A PE of 20 isn't just a vibe, it's a highly specific mathematical output. Let's use an illustrative example to prove how powerful this is. Imagine you're analyzing a broad market stock index, like the S&P 500. It's currently trading at an aggregate forward PE of 19. You do some fundamental digging and find the companies in this index have an average dividend payout ratio of 60%. And based on historical equity risk premiums and current treasury rates, you assume institutional investors require an 8% return to hold this index, so your R is 0.08. We have 3 of the 4 variables. We can use basic algebra to extract exactly what perpetual growth rate the market is secretly expecting.
Let's plug the observable data into our derived equation. 19 equals 0.60 divided by the quantity of 0.08 minus G. We need to isolate G to find the market's hidden assumption.
Right.
First, we multiply both sides by the denominator to get it out of the basement. That gives us 19 multiplied by the quantity of 0.08 minus G equals 0.60. Next, we divide both sides by the PE multiple of 19. That leaves us with 0.08 minus G equals 0.0316. And then rearrange.
Finally, we rearrange the terms to solve for G. We find that G equals 0.08 minus 0.0316. The mathematical result, G equals 0.0484, or exactly 4.84%. Crucial exam takeaway right here. By just observing a simple PE ratio of 19 on a screen and knowing they pay out 60% of their earnings, we mathematically prove that the aggregate global market is actively pricing in a perpetual infinite growth rate of exactly 4.84% for these companies. The implications of this are huge. If you're a fundamental analyst and your deep dive research into supply chains and consumer demand tells you these companies can realistically only grow at 3% long term, what is your conclusion?
Your inescapable conclusion is that the index is fundamentally overvalued. The global market is willingly paying a high multiple of 19 solely because it is hallucinating a 4.84% growth rate. If the companies report earnings and only deliver your projected 3% growth, reality will clash with expectation.
So the multiple has to shrink.
The math dictates that the PE multiple must contract to reconcile with the lower growth rate, and therefore the price of the index will inevitably fall. The PE ratio is not just a number, it is a highly compressed mathematical spring. It stores the market's specific, quantifiable expectations regarding payout policy, required risk premiums, and future economic growth.
That is incredibly powerful. We've mastered the mechanics of bonds, we've valued infinite equity streams, and we've successfully reverse engineered the market's PE ratios to expose their growth assumptions. That brings us to our final overarching pillar, Section 4. The golden rule: cash flow additivity and no arbitrage. If the time value of money formulas we've been using are the individual building blocks of finance, no arbitrage is the fundamental law of gravity that dictates how those blocks must be stacked, ensuring the entire global structure doesn't collapse.
It truly is the foundational law of all financial markets. It begins with the principle of cash flow additivity, which simply states that you can safely add or subtract the present values of different cash flows, provided they occur at the exact same point in time. Because of this additivity, we arrive directly at the ironclad principle of no arbitrage.
Which means?
If two different financial assets or two entirely different investment strategies produce the exact same guaranteed future cash flows, they must have the exact same price today.
And if they don't? What if the market gets sloppy and misprices them?
If they don't have the same price, the market has accidentally created an arbitrage opportunity. In finance, an arbitrage is the holy grail. It's a way to execute a series of trades to lock in a guaranteed risk-free profit requiring zero net investment of your own capital.
Free money.
Literally free money. If two identical cash flow streams have different prices, algorithmic trading desks and institutional investors will instantly spot the anomaly. They will simultaneously buy the cheaper asset and short sell the expensive asset.
Driving prices back in line.
That massive instantaneous wave of buying pressure on the cheap asset will drive its price up, while the selling pressure on the expensive asset will drive its price down. Within milliseconds, the prices are forced violently back into mathematical lockstep. The constant threat of arbitrage is the invisible enforcer of market efficiency.
Let's see this invisible enforcer in action with application 1. Implied forward interest rates. The conceptual scenario is this. A rational, risk-neutral investor has 100 GBP in cash, and they want to invest it safely for exactly 2 years. They survey the bond market and see two distinct paths they can take.
Okay, two paths.
Strategy 1 is simple. They buy a 2-year government bond today that yields 3.50% annually. They lock that rate in, go to sleep for 2 years, and collect their money. Strategy 2 is more active. They buy a 1-year bond today yielding only 2.50%. When that bond matures in exactly 1 year, they will take their initial principal plus the 2.50% interest, and they will roll the entire larger lump sum over into a brand new 1-year bond for the second year. But here is the friction. Sitting here today, we have no idea what the 1-year interest rate will actually be a year from now.
We don't know what it will be when the time comes, but the strict no arbitrage rule allows us to calculate exactly what the aggregate market implies it will be today. Because both Strategy 1 and Strategy 2 tie up the same 100 GBP of capital for the exact same 2-year horizon with no default risk, the no arbitrage rule dictates that the expected final wealth from both paths must be perfectly equal.
If one path was better?
If one path offered a guaranteed higher payout, everyone would take it, abandoning the other path until price is adjusted. Let's look at the payout of Strategy 1. It is 100 GBP multiplied by 1.035 squared. Now, the expected payout of Strategy 2, it is 100 GBP multiplied by 1.025 for the first year, multiplied again by 1 plus the unknown future rate. We denote that unknown future rate as F sub 11.1, meaning the 1-year forward rate starting 1 year from now.
So to force the equilibrium, we set the mathematical outcomes equal to each other. The 100 GBP cancels out on both sides. We are left with 1.035 squared must mathematically equal 1.025 multiplied by the quantity of 1 plus our unknown forward rate. To isolate and solve for that implied forward rate, we take the 2-year compounding factor 1.035 squared, we divide it by the known 1-year factor of 1.025, and then we subtract 1.
If you do that specific arithmetic, 1.0712 divided by 1.025 minus 1 gives you a result of 0.0451, or 4.51%. Think about what we just did. We don't consult an economic forecast. The market is telling you purely through the structural pricing of current 1-year and 2-year bonds that to prevent a massive arbitrage exploit, the absolute break-even 1-year interest rate exactly 12 months from now must be 4.51%.
Let's apply this brilliant concept to a real-world macroeconomic shock. Think back to June 2022. Global inflation is raging out of control. The U.S. Federal Reserve surprises the entire financial system by hiking interest rates by 75 basis points in a single meeting, a massive aggressive move. The source text gives us the actual U.S. Treasury strip prices from May, right before the shock hike, and June, right after the hike.
Okay, let's look at May first.
In the column of May, the one-year Treasury yield was 2.012% and the two-year yield was 2.539%. If we run our exact forward rate math on those calm May numbers, taking 1.02539 squared, dividing by 1.02012, and subtracting 1, we find the implied forward rate was 3.069%. That 3.069% represents exactly what the global market expected the Fed to do over the subsequent year.
But then the Fed drops the 75 basis point hammer in June, signaling extreme panic over inflation. The entire yield curve violently shifts. Suddenly, the one-year rate jumps up to 2.667%, and the two-year rate jumps even higher to 3.177%. If we rerun our forward rate algebraic extraction on the new panic June numbers, taking 1.03177 squared, dividing by 1.02667, and subtracting 1, the new implied forward rate spikes to 3.689%.
This is incredible, because by just looking at the extracted forward rates, you can see exactly how the global market's psychological expectations shifted in real time. Investors didn't just price in the immediate 75 basis point hike that happened that day. The forward rate jumping from roughly 3.06% to 3.68% quantified exactly how much additional future aggressive rate hiking the market suddenly priced into the system to combat the sticky inflation. You aren't guessing what the market thinks. You are reading the market's mathematical mind.
If we connect this localized concept to the broader global picture, you can deploy the exact same no arbitrage logic across international borders. The mechanics of time value of money do not stop at customs. This brings us to application 2, forward exchange rates, which operates on a principle known as covered interest rate parity.
Let's set up the international scenario. You manage a corporate treasury, and you have 1,000 US dollars to invest safely for exactly 6 months. You have two potential paths. Path A is entirely domestic. You keep the money in the U.S., invested in 6-month U.S. Treasury bills earning an annualized 2.0%.
Simple enough.
Path B is international. You convert your U.S. dollars into Japanese yen today, invest that yen in 6-month Japanese government bonds earning a microscopic 0.05% annualized, and then in 6 months you convert those yen back into U.S. dollars.
Right.
To execute Path B safely, you need to know exactly what the exchange rate will be in 6 months so you don't lose all your money if the currency crashes. The current spot exchange rate today is exactly 134.40 yen per dollar. To prevent international banks from exploiting this, there has to be a specific locked-in exchange rate for 6 months from now, a forward exchange rate contract you can sign today.
Let's carefully walk through the dual timelines to find that required forward rate. First, look at the domestic U.S. strategy. You invest 1,000 USD at 2.00% for 6 months. Because the source material for this specific example uses continuous compounding, we use Euler's number E. We take 1,000 multiplied by E through the power of the rate times time 0.02 times 0.5 years. Your 1,000 USD naturally grows to exactly 1,010.05 USD in 6 months.
And the Japanese strategy.
Now, look at the Japanese strategy. You take your 1,000 USD today and convert it at the spot rate of 134.40. You are now holding 134,400 Japanese yen. You invest that pile of yen at the much lower 0.05% Japanese interest rate for 6 months. Using the same continuous compounding math, it barely grows at all, becoming roughly 134,433.60 yen.
So standing at the 6-month finish line, I have 1,010.05 guaranteed dollars in my left hand from the U.S. strategy, and I have 134,433.60 guaranteed yen in my right hand from the Japanese strategy. Because both of these risk-free 6-month strategies started with the exact same initial capital of 1,000 USD, the ironclad law of no arbitrage states they must end up with the exact same final dollar value.
Therefore, the 6-month forward exchange rate must mathematically balance the scales between those two hands. To find the exact rate, you divide the final accumulated yen amount, 134,433.60, by the final accumulated dollar amount, 1,010.05. The required mathematically sound forward exchange rate is exactly 133.09 yen per dollar.
That's the exact rate.
Why does this matter? Because if a rogue bank offered a forward contract at 135 yen or 130 yen, a sophisticated hedge fund algorithm would instantly spot the discrepancy. The fund would simultaneously borrow money in the low-rate currency, lend it in the high-rate currency, lock in the rogue forward rate, and extract millions in risk-free profit without using a dime of their own capital. The market price of 133.09 is not a guess. It is strictly dictated by the interest rate differential between the two nations.
It's a brilliantly interconnected web. The forward exchange rate is firmly tethered to the sovereign interest rates, which are in turn firmly tethered to the foundational time value of money. And to round out this deep dive, we need to significantly expand on application 3, which proves this exact same pricing. No arbitrage logic applies to highly complex derivatives, specifically option pricing. The curriculum touches on this, and it is a massive conceptual leap. An option gives you the right, but not the obligation, to buy a stock at a certain price in the future. How do you price something that is basically an insurance contract on a stock's volatility?
The breakthrough in quantitative finance, which eventually won a Nobel Prize, was realizing you don't have to guess what the option is worth based on human emotion. You price a call option by meticulously building what is known as a replicating portfolio. The theory relies entirely on our golden rule. If two things produce the exact same cash flows, they must cost the same today.
Okay, so if I want to figure out the fair price of a call option on a stock, I have to figure out a way to perfectly mimic that option's payout without actually using an option. How do I build this synthetic clone?
You build the clone using two highly liquid instruments, the underlying stock itself, and a risk-free bond. The key is finding the correct hedge ratio, which is a specific mathematical fraction. Let's say you calculate the hedge ratio is 0.5. That means for every $1 the stock price moves up, the option's value moves up 0.50 cents. To perfectly mimic the option sensitivity, you go into the open market and you buy exactly half a share of the actual underlying stock.
Okay, so I buy half a share. If the stock goes up $1, my half share makes 50 cents, which perfectly matches what the option would have made. The cash flows match. But there's a massive problem with my clone. Buying half a share of a $100 stock costs me $50 out of pocket today. Buying an option contract might only cost me $5. I've tied up way too much capital. My clone is too expensive.
That is where the risk-free bond comes in to balance the scales. To offset the massive capital outlay of buying the physical stock, your replicating portfolio strategy dictates that you immediately borrow money at the risk-free rate. By borrowing the cash to fund the stock purchase, you drive your net out-of-pocket costs down to a fraction of the stock price.
So it's a combination.
Your replicating portfolio consists of two deliberate actions: holding a fractional share of stock and holding a negative cash balance alone. The miraculous mathematical result of combining those two actions is a portfolio whose future payoff profile perfectly, identically mimics the future payoff of the call option in every conceivable future scenario, whether the stock crashes or moons.
And because of the unbreakable law of cash flow additivity we just discussed, if my Frankenstein replicating portfolio, the half share of stock minus the borrowed cash, produces the exact same final cash flow as the call option, then the present value of my portfolio must exactly equal the price of the option today. I don't need a crystal ball to price the option. I just need to calculate the net cost of buying the fractional stock and borrowing the money.
It is the ultimate, most sophisticated expression of the no arbitrage principle. It proves that every financial instrument in the world, no matter how intimidating or complex it appears on the surface, can be analytically decomposed into its fundamental component cash flows, rigorously discounted backward through time using interest rates, and priced relatively to everything else in the market. The financial world is not random. It is bound by mathematical relativity.
Wow. We have covered a truly staggering amount of ground today. If you have tracked with us through this entire hour, congratulations. You just made it through an incredibly dense, highly rewarding quantitative deep dive. Let's recap the epic journey we just took. We started at the absolute ground floor, drawing a simple timeline and dragging a single 100 rupee zero-coupon bond payment backward through 2 decades.
We covered a lot.
We took those tools and expanded them to value complex level payment mortgages. We conquered the concept of infinity by valuing perpetual dividend streams from mature equities, and we mathematically handled the erratic life cycle of hypergrowth tech startups.
Right.
We then flipped the equations completely backward to unearth the global market's hidden expectations for yield and growth just by dissecting a standard PE ratio. And finally, we proved how the constant looming threat of algorithmic arbitrage is the invisible hand that keeps global interest rates, international currency markets, and synthetic option prices locked in perfect unshakable mathematical step.
It's all connected.
So what does this all mean? For you, the learner, it means you're no longer just rotely memorizing a disconnected list of formulas to pass a multiple-choice test. You are finally seeing the matrix. You are seeing the hidden mathematical scaffolding that holds the entire global financial system together. You now understand that every single price you see blinking on a screen is not a random occurrence. It is a precise, calculated reflection of time and risk.
This raises an important question for you to ponder as you continue your studies. The entire elegant architecture of the time value of money we painstakingly built today relies on a very specific foundational assumption. It relies on the assumption of linear, predictable time and the existence of stable, observable discount rates.
Yes, it assumes normal conditions.
But what happens to the mathematical fabric of these global markets when we experience massive, unprecedented black swan events? Events like a sudden global pandemic, a sovereign debt default, or a flash crash where time seems to stand still, market liquidity completely evaporates overnight, and traditional measures of risk become utterly incalculable.
That's a scary thought.
Does the flawless math actually break down in those moments of extreme, visceral panic? Or does the math simply do its job and expose the terrifying reality that our smooth, stable inputs, our steady required return R, and our perfectly constant growth rate G were merely an illusion of safety we collectively told ourselves to feel better about the future? Keep that critical thought in mind as you deploy these models in the real world. The quantitative models are perfect, unyielding reflections of our human expectations, but our human expectations are not always perfect reflections of reality.
A brilliant and sobering thought to leave off on. The map is not the territory, even when the math drawing the map is flawless. Thank you for joining us on this exhaustive deep dive into the time value of money. Keep studying the material, keep asking the hard questions about why the formulas work, and we will catch you on the next one.